Two Nobel Prize winners walked into the market with the most sophisticated financial model ever built. They had the data, they had the math, they had decades of combined expertise. They had the backing of the most powerful banks on Wall Street. In less than 4 months, they lost $4 billion. Warren Buffett watched it happen. He was not surprised because he had seen it before: brilliant people, armed with brilliant thinking, walking straight into financial ruin. He called it the most predictable tragedy in investing. And he said the cause was not bad luck. The cause was intelligence. The fund was called long-term capital management. The men running it were not amateurs playing at finance. They were John Meriwether, one of the most respected bond traders in the history of Wall Street. They were Myron Scholes and Robert Merton, two economists so brilliant that the Nobel Committee gave them the prize specifically for the mathematical models they used to run the fund. They had former Federal Reserve officials. They had physicists. They had the kind of intellectual firepower that, in any other field, would be considered an overwhelming competitive advantage. For 4 years, the model worked. The returns were extraordinary. The confidence grew. The positions got larger. And then in the summer of 1998, the real world diverged from the model. Russia defaulted on its debt. Markets moved in ways the model said were statistically impossible. And the fund, built by the most credentialed minds in finance, running strategies so complex that most investors could not even understand them. Nearly $4 billion. Gone. Warren Buffett was asked to comment. He said something that most people in finance dismissed as folksy oversimplification. He said to make money they did not have and did not need, they risked money they did have and did need. That is foolish. It does not matter what your IQ is. But here is what most people missed about that statement. Buffett was not just commenting on leverage or risk management. He was identifying something deeper, something that explains not just long-term capital management, but dozens of similar collapses before it and after it. Something that explains why, across 60 years of observation, the smartest people in every room have consistently produced some of the worst investment outcomes. Intelligence applied incorrectly, which is how most intelligent people apply it, is one of the fastest paths to financial destruction ever discovered. Today we are going to understand exactly why and what to do instead. Here is the first thing you need to understand about intelligent people and money. Smart people believe they have an edge, and in most areas of life, they are right. Intelligence is genuinely useful in medicine, in law, in engineering, in science. The smarter you are, the better your outcomes tend to be. The relationship between cognitive ability and performance is clear, direct, and reliable. Financial markets are different. And the difference is not obvious until it destroys you. In most fields, the competition is not actively trying to exploit your overconfidence. A difficult surgery does not become more dangerous because the patient is hoping you will fail. A complex legal brief does not become more treacherous because the opposing counsel knows you believe you are smarter than you are. But financial markets are composed entirely of other participants, millions of them, many extraordinarily intelligent, all of them trying to profit from your errors in judgment. Every time you believe you have found an opportunity that others have missed, you are making an implicit claim that you are right and the collective intelligence of everyone else who looked at the same information is wrong. Sometimes that is true, but the painful irony, the irony that has destroyed more brilliant investors than almost any other force, is that the smarter you are, the more convinced you are that you belong in the category of people who are right. The more certain you feel, the larger the position you take, and the more catastrophically wrong you can be. Buffett calls this the problem of false precision. Intelligent investors build elaborate models. They run sophisticated analysis. They construct detailed frameworks. And the more sophisticated the framework, the more real it feels, the more it generates the sensation of certainty where certainty does not exist. The model is not reality. The map is not the territory. And when the real world diverges from the model, as it always, eventually, inevitably does, the investor who trusted the model completely has no defense. They did not build in the possibility of being wrong because the model told them they were right. Buffett's answer to this is what he calls the margin of safety, a deliberate built-in acknowledgement that his analysis, however careful, however thorough, might be wrong. He buys at a significant discount to what he thinks something is worth. Not because he lacks confidence, because he has enough wisdom to know that his judgment is still an approximation of a reality he cannot fully see. The brilliant people at long-term capital management did not build in that margin. The model told them they were right. They believed the model. They always believe the model. Stop for a moment and ask yourself something honest. When was the last time you heard a financial expert explain their strategy in simple terms and trusted them more for it? Almost never, because in the world of money, complexity signals sophistication. A 7-factor model sounds more rigorous than a 2-factor model. An algorithm that incorporates 40 variables sounds more reliable than one that considers 4. The more intricate the framework, the more it seems like the person using it has access to a layer of understanding that ordinary investors cannot reach. Warren Buffett has spent 60 years doing the opposite, and it has made him one of the wealthiest human beings who has ever lived. His investment framework, stripped to its essentials, that is almost embarrassingly simple. He looks for businesses he understands. He looks for durable competitive advantages. He looks for honest management. He buys at a fair price. He holds forever. No algorithm. No proprietary data feed. No complex derivative structure. A checklist that any reasonably intelligent person could understand in 20 minutes. He has said more than once that if you need a computer to evaluate an investment, you should not make it. If you cannot explain why a business is worth owning in plain, clear language, the complexity is hiding something. Usually risk. Here is what Buffett understands that most intelligent people spend years learning too late. Complexity and accuracy are not the same thing. Adding variables to your model does not make your conclusions more reliable. It makes them more fragile. Every additional assumption is an additional point of failure. Every additional factor is one more thing that can turn out to be wrong. The simple framework, applied with patience and discipline, outperforms the complex framework almost every time. Not because it is right more often in individual cases, but because when it is wrong, and it will sometimes be wrong, it is wrong less catastrophically. And because it can be executed consistently, without breaking down, across decades. Long-term capital management's model was extraordinarily complex, and it was exactly right until it was catastrophically wrong. The complexity that had generated the returns became the mechanism of the collapse. Every variable that had been calibrated to normal markets became a liability in abnormal ones. Simple systems break gracefully. Complex systems break all at once. There is a specific behavior that distinguishes intelligent investors from almost every other type. They trade too much. This is counterintuitive. You would expect that smarter people who understand transaction costs, who can calculate the tax drag of realized gains, who know the research on overtrading would make fewer unnecessary moves. The knowledge should translate into restraint. It does not, and the reason is psychological in a way that cuts directly to the core of what intelligence actually is. Smart people are pattern recognizers. It is the defining cognitive feature of high intelligence. They see information and they immediately see implications. They read a quarterly earnings report and identify 3 things the market has not yet priced in. They hear a central bank announcement and construct a thesis about how it will ripple through 6 different asset classes over the next 18 months. The mind is constantly generating insights, and every insight feels like an obligation. Buffett has described this as one of the most expensive mistakes intelligent investors make, treating their own intelligence as an asset that must be constantly deployed. Holding still, doing nothing, watching the portfolio sit unchanged while the mind runs at full capacity feels wrong. Like waste, like the intelligence is being squandered. But trading is not thinking. Activity is not analysis. And the costs of unnecessary transactions, direct costs in fees and taxes, indirect costs in the mistakes that follow from overconfidence, compound against you just as powerfully as good investments compound for you. Buffett has compared the ideal investor to a baseball player at the plate with no called strikes. You can watch pitch after pitch go by without penalty. You can wait indefinitely for the perfect opportunity. The discipline is in the waiting. The intelligence is in resisting the urge to swing at pitches that are almost perfect but not quite. Smart people swing at everything. Their minds generate constant justification for action. They can always construct a plausible argument for why this particular trade, at this particular moment, is different, why the rules of patience that apply to ordinary investors do not apply here. The intelligence that should be protecting them is instead generating the rationalization for destroying them. But because intelligent people are extraordinarily good at not seeing their own mistakes. Not because they are dishonest, not because they lack self-awareness, but because the same cognitive machinery that makes them smart, the ability to construct coherent narratives from incomplete information, to find patterns, to build arguments, makes them remarkably effective at constructing post hoc justifications for decisions that have gone wrong. A smart investor buys a stock. The stock drops 20%. An ordinary investor gets nervous and starts questioning the thesis. The brilliant investor does something different. They revisit the analysis. They find new factors that support the original conclusion. They construct a narrative in which the drop is a temporary mispricing, a market overreaction, a buying opportunity, confirmation that the market does not yet understand what they understand. They add to the position. Sometimes they are right. But more often, far more often than they would admit, they are doing something psychologists call motivated reasoning. Using intelligence not to find the truth, but to defend a conclusion they have already reached. And the smarter they are, the more convincing the defense. The more convincing the defense, the longer they stay in a position that is quietly destroying them. Buffett has a practice he calls the inner scorecard, an honest private accounting of decisions, not the version you would tell others, not the version that makes you look prescient, but the unvarnished truth of what you got right and what you got wrong and why. He has discussed his worst investments in considerable, almost uncomfortable detail, not to perform humility, because understanding exactly how he was wrong, what assumption failed, what he failed to see, what he mistook for certainty that turned out to be hope, is the only protection he has against being wrong in the same way again. This is perhaps the rarest quality in highly intelligent people. The willingness to be genuinely, accountably wrong, not performatively humble. Actually wrong, actually mistaken, with consequences that do not get explained away. Most brilliant investors never develop it. They are too good at being right or at feeling right to practice being wrong. What does Buffett do instead? He built a fence around his own intelligence. He calls it the circle of competence. And it is not a metaphor, it is a daily operating constraint that shapes every single investment decision he makes. Inside the circle are the businesses and industries where his knowledge is deep enough that he can form a genuinely independent judgment, where he understands the economics well enough to know when something is cheap and when it is expensive, where he has seen enough cycles to know how the business behaves under stress. Outside the circle is everything else. That is a match. And his discipline, the discipline that most intelligent people find almost impossible to maintain, regardless of how attractive the opportunity appears, regardless of how much others are making from it, regardless of how much he might miss by staying inside. He famously missed the early technology boom. He did not invest in Microsoft despite knowing Bill Gates personally. He did not invest in Google despite using it every single day and recognizing it as a business with an extraordinary moat. He stayed inside the circle. The returns he missed were extraordinary. He has no regrets, because the circle of competence is not about maximizing opportunities. It is about preventing the one kind of mistake that actually destroys wealth, the confident, well-reasoned, intelligently argued mistake made in territory where you do not genuinely know what you do not know. Intelligent people expand their circles on paper. They study an industry for 6 weeks and decide they understand it. They mistake familiarity for knowledge. They mistake the ability to construct a plausible narrative about something for the deep, experiential understanding of how it actually behaves across different conditions. Buffett does not make that mistake. After 70 years of investing, his circle remains deliberately, almost stubbornly narrow. Not because he lacks the intellectual capacity to expand it, because he has enough wisdom to know the difference between understanding something and feeling like you understand something. That difference, which sounds small, is everything. Buffett has said something that stops most intelligent people cold. He has said that the most important quality for an investor is not intelligence. It is temperament, not IQ. not analytical skill, not access to better information or more sophisticated models. Temperament. By this he means something precise. The ability to remain rational when the people around you are not, to hold a position when the market is screaming that you are wrong, to do nothing when doing something feels essential, to be genuinely comfortable not performing comfort, but actually feeling it with the uncertainty that is permanent and irreducible in financial markets. These abilities have almost no correlation with intelligence. Some of the most intellectually gifted investors Buffett has known are also some of the most emotionally reactive people who are brilliant in a classroom and paralyzed in a downturn. People who can construct a perfect argument for why they should hold steady and then sell at the exact bottom because the anxiety became physically unbearable. And here is the cruel irony. Intelligence often makes this worse. Because a smart person can always find a compelling reason to do what feels emotionally necessary. The mind serves the emotion and calls it analysis. The rationalization is so sophisticated that it is indistinguishable from genuine reasoning to everyone, including the person doing it. Buffett does not experience market downturns as threats. He experiences them as sales. He does not feel the social pressure to be doing something when everyone around him is doing something. He does not need the market to validate his positions. He checks his own reasoning, not the market's opinion of his portfolio. This is not a skill that can be acquired from a book or a course. It is a disposition, partly built into how his emotional system responds to uncertainty, partly developed over decades of deliberate, consistent practice in treating his own reactions as data rather than commands. But it can be moved toward. And the first step is the most important one. Recognizing that your intelligence, your ability to generate convincing justifications for almost any position, is as likely to work against you as for you. Possibly more likely. The smartest thing a smart person can do in financial markets is to create rules that prevent their own intelligence from outsmarting them. The fall of 2008, as the financial crisis tore through the portfolios of the most sophisticated investors in the world, Warren Buffett wrote a public letter. He said he was buying American stocks aggressively with his own money. The reaction from the financial establishment was immediate. The models said the situation could get worse. The data was unclear. The risk was impossible to quantify. Virtually every credentialed, sophisticated, intellectually serious voice in finance was either selling or sitting frozen, waiting for more information. Buffett did not have more information than they did. He did not have a model that proved the bottom was in. He had something simpler and rarer, a temperament that allowed him to act on a principle he had held for 60 years, that when great businesses are available at panic prices, you buy them even when every sophisticated voice in the room was constructing arguments for why this time was different. He was not smarter than the people selling. He was simpler. He was calmer. He was operating from a framework he had tested across multiple crises and trusted completely, not because it was complex, but because it was honest. Intelligence is a gift. Genuinely, in financial markets, it is a gift that requires unusually careful management. Left to its own devices, it generates overconfidence, overtrading motivated reasoning, and a chronic inability to sit still while a simple system does its quiet work. Managed correctly, disciplined by a genuine circle of competence, protected by a margin of safety, grounded in a temperament that values being right over appearing smart, intelligence becomes one of the most powerful wealth-building tools available to any investor. The difference between these two outcomes is not more intelligent. It is the wisdom to know when to stop using it. Warren Buffett is not the most intelligent investor who has ever participated in financial markets. He has said so himself, and he means it, but he understood, earlier than almost anyone else, that in this particular game, being too smart is its own kind of trap. That the mind which can construct a brilliant argument for almost anything is also the mind most capable of constructing a brilliant argument for the wrong thing. He built a fence around that mind. He defined its boundaries carefully. He stayed inside them. He let the machine run. The question is not how intelligent you are. The question is whether you are wise enough to know what your intelligence cannot do and disciplined enough to stop there.